As promised last week, we are really going to look and take a different angle on retirement savings this week. It's something that we have spoken about before. Every time we speak about it, the lines light up, the messages come in. I get lots of messages that I need to reply to afterwards, which is really what the show is all about. But there are three basic myths that we'd like to debunk today when it comes to retirement and it comes to retirement savings. The long and the short of it, folks, there's no shortcuts and there's no magic elixir and there's no magic wand. It's all about putting money away, putting it away correctly and putting it away for long enough. So on the line with me now is a gentleman called Nick Horn, who's Director and Regional Head of Durban Citadel, or Citadel in Durban. Nick, welcome to High FM.
Hi, Ivy. Thank you for having me.
Pleasure. Nick, we've got a short time, so let's get straight into it. The long and the short of it is we know that scary statistic that's thrown around that, roughly 8% of South Africans will be able to retire. In other words, at retirement date, the salary they got in their last month, in other words, be able to draw 75% of that value for the rest of their lives until they pass away, which basically relates to realistically drawing 5% of the value of your assets when you retire, should give you enough money and enough asset to pull down for the foreseeable future. Could you just elaborate a little bit on that, please?
Look, it's a commonly known stat. It's an old South African and quite a sad stat that a significant proportion of South Africans, when they retire, cannot live the kind of lifestyle that they lived, I guess, when they had cash flow, when they were working, when they were earning an income. So that's a commonly known stat. The 5% number really is, if you have accumulated assets, let's say you're in a corporate and you've accumulated some pension money and some cash on outside of that. If you were able to live off 5% of your assets and they were managed properly, they could probably last you forever. And that really was the point around that 5% number. And, I guess the shortcut way of doing it is to say, switch that around. I often get asked the question, do I have enough money? And my answer to that is, well, how much do you spend? What do you want your lifestyle to be? If you can take that number and annualize it, you just multiply that by 20, that's your 5%. That's kind of the capital that you would need to sustain the kind of lifestyle that you want to lead.
So Nick, let's play with figures here. Let's use 100,000 Rand a month. Times that by 12 is 1.2 million. Let's ignore tax for now. Times that by 10 is 10.2. Times that by 20 is 20.4. So if someone's looking at retiring and they've got 20.4 million rands worth of assets, but assets that are generating an income. In other words, if your home is worth 15 million, it doesn't come into the equation.
No, that I would call a lifestyle asset. That's different. But of course, one could gear up your home at a later stage. When I say gear up, you could, downsize and maybe free up some capital from your home. But the number, we're talking financial assets, straight financial assets that can sweat for you.
Exactly. So when you're talking about sweat, in other words, they will produce an income. So let's again use some realistic numbers. If we could get, let's say, between 8 and 9% net return on our money, which in this market's a bit ambitious, but let's say we could get that, and we're only drawing 5%. We've got a 3% real growth that's happening on our money. And is that why it should last indefinitely?
Look, that number, when you start to project it in real terms over time, your capital will deplete in real terms. But you're never actually going to notice that because the report you get on your investments will show, in that case, probably a rising rand value. But of course, you're spending more. Your 100,000 Rand this year is going to need to be 110,000 Rand next year, and 125,000 Rand the following year because of inflation. So you need an element of real return over and above that 5%. Yes, absolutely.
Great. We do need to, Nick, run to the shops quickly just to take an ad break. But before we go, I just want to read out one line that you put in the press release, which was really, really poignant. It says, the most common theme underlying retirees' lack of savings includes saving too little, I can live with that, cashing in savings at resignation or retirement, which is a common story, investing too conservatively, which is something I'd like to discuss. And the last one, which I found very poignant, and it continued continue to provide for children and parents. That's something that's often not taken into the equation. Children you can't really budget for, but you're not quite sure whether your child's going to go on to do an honours, a master's, a PhD, and then start another degree and still live at home, or actually just never get off the couch. But you would know early on in life whether your parents do or don't have enough money and what your responsibility will be, and then you can factor that into your retirement planning. Online with me is Nick Horn, is the Director and Regional Head of Citadel in Durban. Nick, the sentence I read out before, where people don't save enough, don't save early enough, use their money on retirement instead of preserving it or transferring it to the new fund. But this obligation to look after parents, it's often seen as a typically South African issue where, there's a greater extended family and one has to look after it. But the reality is that a young person in the early 20s or late 20s or early 30s should know at that stage whether their parents are going to be able to retire or not. And if not, that needs to be taken into consideration, especially things like medical aid costs.
Yes, absolutely. So one of the tragedies is that I often get to see people very, very late in their stage of planning. And when they started to plan for retirement, they actually, they'll do a 10-year projection or a 5-year projection, and it all looks good. The problem is that after 10 or 12 years, when your compounding effect of inflation and cost kicks in, your model starts to go horribly wrong, and that includes, as the longevity of parents, kids being dependent for a hell of a lot longer. So yes, you have to start taking that into account very early on in your planning. So it's not just your own longevity that becomes an issue later on, it's also the longevity of possibly parents.
Absolutely, and that's something that's becoming more and more common. We're seeing more and more of that.
Yes.
Very simply because, not simply, but one of the reasons being is that the cost of medical inflation, the cost of medical aid, the cost of longevity, all that comes into play with your parents. But maybe let's go to the three issues that I mentioned before that we wanted to discuss. The first issue you put down here is DIYing your investments and see how much money you can save. In other words, going it alone. Unpack that a little bit for us.
Look, there's two issues there. People DIY because there's this perception that it's cheaper. That might be the case. But it takes a huge amount. I just look at it from our own business, our own point of view within Citadel. The time and effort and the research we have to put in around just a thing like asset allocation is massive. And an asset allocation in this process is everything. I have an investment qualification, but I would never dream of trying to outguess the asset allocation or good asset allocation from a team of top economists. So when you do it on your own, you're faced with those decisions. The second issue is when you try to make those decisions, emotion becomes a problem because you cannot disengage from your own stuff, whether it's your money, your relationships. When you have such a close bond with an asset like that, like your own money, you just cannot be objective. So a sounding board, an advisor, somebody that stands between you and your money is critical in doing this and doing it successfully on an ongoing basis.
It's so interesting how emotion plays such a pivotal role in both your own planning and yet in the markets also. We've just seen today, for example, load shedding had a direct impact on the rand. Has it hit business yet? Has it hit the bottom line of businesses? Well, we've learned from the past that demands did suffer, but South African business is resilient and they'll make a plan, they'll work later, they'll somehow come out of it. But yet the rand, just because of the perception, the rand already got hit. So too with yourself. You're going to be able to stand back and say to a third party, give me an honest, objective opinion, and then I will implement that which you tell me, because otherwise emotion comes into it.
Yes, correct, 100%.
Great. Then the next thing is longevity, and here to maybe just unpack it from my own experience is that, retirement age used to be 55. It still is the earliest legal retirement age. That doesn't mean you can't retire at 40 if you've made the money. You just can't access your retirement money. at age 40. That's what it means. And now 65 has really become the norm. And all of a sudden, product that expired at 70 doesn't expire anymore. Companies are adjusting it simply because the life expectancy has been pushed out. But how does that affect someone's retirement savings?
If you live 10 years longer than you might have anticipated when you started doing your planning, and let's say you retire at 65, your life expectancy might have been to 90. So what's that? That's 25 years.
Right.
Now it's 35 years. So your capital's got to last 30-odd% longer than it might have needed to last when you did your planning. So that's the first, probably most sinister impact. But what I was also trying to get at around this longevity is that you live longer, but you live a much better quality of life for longer. And I've been fortunate in my experience at Citadel. I've been observing retirement very closely for 25 years. The bulk of our clients are people that have accumulated funds to retire. And my own observation is that people that can successfully retire become, certainly they're at their maximum value, earning potential, knowledge, experience at the time that they retire. And they very seldom just can put their feet up and relax. They often get engaged directorships, consultancies. Their skills are valuable. There's a lot of commerciality in the skills and experience that they've accumulated. So you might retire, but you might not have to live off all your savings. You might be earning an income for a while, which in itself defrays your expenditure for a period of time. So it's been fascinating for me to see how even though people are older, they're still able to add massive value into the economy.
So that's really things that to take into account. Another thing is, how does medical inflation affect retirees? Because one thing we know is medical inflation is above normal inflation. So if you're working on fixed interest returns on your money and you're getting a good return today, despite the adverts on the highways, let's say you can get 6.5%, maybe 7%. Medical inflation's running comfortably over 10. Is that a concern?
Absolutely, and it's a problem. So as a proportion of your monthly expenditure, the medical portion of that just then constantly rises. So, in fact, when we do a projection, we tend to strip out medical inflation as a separate cost item. And it might mean over time you need to trim your lifestyle in other parts of your expenditure to cater for that. But that's all part of the planning. You do need to strip out medical costs, and then you do need to accumulate them at a higher rate than inflation, because that then gives you a much truer answer in terms of the capital adequacy of what you've accumulated.
On the line with me is Nick Horn, who's Director and Regional Head of Citadel in Durban. Nick, the last thing we want to discuss now is debt. Debt is something that chews into everybody's monthly budget. Before we get on to the negatives and the bads and one thing I loved about what you put here is that debt is a realistic part of everybody's life. It's not something that is evil and bad that you need to avoid at all costs. Some debt allows you to accumulate wealth. Let's talk through debt maybe a little bit earlier on in one's life as you're building your asset base, and then how to manage it into retirement.
So why I addressed this issue was, it's a very old-fashioned statement. Debt is bad. There's a thing around debt. But you have to have debt to fund an asset. You have to have debt to drive a motor vehicle. The issue is just, over-gearing is not good. Gearing or taking on debt to invest is not good because it's not tax effective. But taking on debt to fund an asset makes complete sense. I also wanted to distinguish between long-term debt, which is that kind of debt, asset funding, versus short-term debt. The short-term debt is buying clothes on credit, and when you pop your credit card at the supermarket, going on budget versus paying for the thing immediately.
Right.
So this is distinguishing between long-term debt, which is effective debt, and short-term debt. And short-term debt's the one that you've got to be very careful of. But debt is essential. Debt is what growth comes from debt, from borrowing.
Sorry, isn't that what Robert Kiyosaki refers to as good debt and bad debt?
Yes, in a manner of speaking, yes.
Great. So very effectively, what we want to make sure is that in our growth spurt, our growth region, when we're earning and when we're saving, that we're putting as much as we can away towards retirement savings and servicing as little as we can or none on short-term debt. In other words, living beyond our means on debt.
Yes.
And what we want to make sure is by the time we get to retirement age, all those other assets that we are funding with long-term debt, like properties that we live in or property that we live in, investment properties, other investments that you've geared in order to buy, all those should be settled by the time you retire, so that that cash flow that's negative that's going out to service that debt is no longer part of the budget.
Yes, agreed. Always close. You don't often get it right, but certainly in my own life, my focus is on my long-term debt. I try and get rid of it as quickly as I can, which allows me to save. There's also got to be a bit of a balance, though, because compounding is the eighth wonder of the world. So you do want to get your long-term debt down, but there's also got to be a balance between that and then how much you start accumulating into growing your capital base. And that's it's a tricky one to manage, but there needs to be a balance there as well.
Okay, fantastic. Nick, I really like the way you've put this whole thing together. How do people get hold of you if they want to discuss the retirement savings with you a little bit further?
They're welcome to visit our website, citadel.co.za. My name is on there along with all the other directors of Citadel, and anyone is more than welcome to contact me at any stage.
Fantastic. Nick, as always, thank you so much for your time. Thank you for coming on, and thank you for the concise way you've put it, and also the realistic way and practical way that you've released the information. Consider the matter of fact that all debt is bad and you should never have debt. The bottom line is that things cost a lot, especially in South Africa. School fees are high, medical expenses are high, cost of inflation for food is ever increasing, and the realistic viewpoint is really what makes it a little bit more manageable. Thank you so much for coming on, and have a great day.
Thank you, Avi. I hope that was of value. Thanks very much.
Fantastic. Thank you. Just to repeat, that was Nick Horn, Director of and Regional Head at Citadel in Durban. Please get a hold of them at citadel.co.za. Go along and have a look.